Hi everyone, Namaskar. I'm Aditi Gupta and I'm going to walk you through everything you learned in the first year over the course of this video. Please listen carefully since we will be testing this material in the form of a quiz within the next few weeks. I first introduce key concepts and then follow that up with associated quiz questions. These are sample questions to make sure you understand each concept that is covered. We will be covering topics in organizational behavior, finance and accounting, cost management, business statistics, international business, management information systems, and marketing. First up is organizational behavior. In case you would like to refer to your textbook, the relevant pages are page number 7, pages 285 and 286, pages 306 to 311, as well as pages 506 and 507. Soon, many of you are going to be working as managers in companies, and so it's important to understand what are some of the leadership skills you need to succeed. And there's no better example of leadership than MS Dhoni, India's most successful cricket captain, whom I'm sure you all know. So think of Dhoni and the leadership qualities he brings in terms of staying cool under pressure, motivating the team, and taking tough decisions. Similarly, you, as a team manager, are going to have to motivate your team, communicate information to them, and take tough decisions when it comes to allocating resources, negotiating deals, and new business opportunities. So, the first sample quiz question is here, and it is: what are the roles of a manager? Please pick the best answer. And your options are leadership, communication of information, decision making, or all of the above. Please note that answers to all sample quiz questions will be given in class. So, what does it take to build a successful team? One of the key qualities is leadership. Think again of India's top cricket captains, MS Dhoni and Virat Kohli, and the qualities and attitude they bring that help India win. Also think of team composition. There are players of diverse abilities. Some are good at batting, some are good at fielding, some are good at bowling, but we need them all in the team. There are also people with different personalities. So while Dhoni is Captain Cool, staying very cool under pressure, Kohli is a little more emotional. But again, remember, both always play with the common purpose of winning for India. And so, as a team player, what you always need to do is ensure that the team as a whole wins. So, the next quiz question is: what are the important ingredients for building a successful team? Please choose the best answer. And your options are leadership only, leadership and trust, leadership, trust, and people with diverse abilities, or people with diverse abilities only. So, what does it take to make good decisions in a team? The goal really is to encourage everyone to share their ideas and opinions so that the best decisions are made in the interest of the team. Technology and growth of internet can certainly help in this process. Both in class and the organizations you join upon graduating, you will work in teams, and I urge everyone to speak out freely. So don't hold back, but just share your ideas. So the next quiz question is: what habit should be avoided when it comes to group decision making? Again, choose the right answer. Sharing ideas, sharing independent opinions, making the best decisions in the interest of the team, or thinking alike, i.e., repeating whatever your teammates say. So, what does it take to build a successful team or organizational culture? One of the key elements in any venture is innovation and risk taking. Take the movie business, for example. You all must have seen Rajnikant's very successful movie called Enthiran or Robot. It's a science fiction movie which involved heavy investment of money and therefore was a risk. But I guess with Rajnikant and Aishwarya Rai in the lead, it had to be the big hit it was. Another element of any successful organization is its orientation to results. In the movie business, When the movie releases on Friday, if it's a hit, the leading actors get more work, and if it's not a hit, then they often go out of work. Similarly, any organization has to be team oriented. It's not just about the leading actors, it's also about the support staff, the cameramen, the makeup men, and the many others who contribute to the business. Last but not least, there's an element of competition in any business. Again, the movie business is highly competitive. There are so many people who aspire to be top stars like Shah Rukh, Salman, Amir, or Rajnikant, but very few actually make it. So the next quiz question is, what are the key elements of organizational culture? Your options are innovation and risk taking, orientation to results in team, competition and aggression, or all of the above. We now begin the section on financial management and accounting. You can refer to chapters 3, 5, 6, 11, 12, and 34 of your financial management textbook, as well as chapter 1 of your financial accounting textbook. Let's take a look at the profit and loss or P&L account of a manufacturing company. Let's say it's a manufacturer of mobile phones or handsets. The top line is net sales or the revenue of the business, which is essentially the price of one mobile phone into the number of mobile phones sold by the company. In this case, net sales is 701 crores. Cost of goods sold is the direct cost incurred by the manufacturer. That is the cost of raw materials, labor, and other overhead expenses. Gross profit is simply net sales minus cost of goods sold. Selling general and administrative expenses or SG&A expense are the indirect costs of labor and other administrative expenses incurred by the manufacturer. Depreciation is the wear and tear of fixed assets such as the plant and machinery which are used to manufacture the hand phones. Operating profit is simply gross profit less SG&A expense less depreciation. Interest is payable to the bank on loans taken from the bank to purchase fixed assets like plant and machinery, vehicles, and other fixed assets of the manufacturing enterprise. Profit before tax is simply operating profit less interest expense. Taxes are payable on profit of the business, and profit after tax is simply profit before tax less taxes. Profit after tax, or PAT, is the bottom line. The next quiz question is, how is gross profit calculated? And your options are net sales minus cost of goods sold, or net sales minus COGS minus SG&A, or net sales less COGS less SG&A and depreciation, or finally net sales minus COGS minus SG&A minus interest. Let's see how some key financial ratios are calculated. This is a very important slide since we'll be referring to some of these formulas in class as well. So what is gross margin? Gross margin is simply the gross profit of the business divided by the sales of the business. If we apply this to Horizon Limited, the gross margin works out to be 21%, which is simply the gross profit of 149 crores divided by the sales of 701 crores. Similarly, we can work out operating margin. It is simply operating profit divided by sales, and net margin, which is our profit after tax divided by sales. In the case of Horizon Limited, operating margin is 13%, while net margin is 5%. The next quiz question is, what is gross margin? And your options are profit after tax divided by sales, or profit before tax divided by sales, or is it gross profit over sales, or is it operating profit divided by sales? Now let's look at the profit and loss account of a solar rooftop power plant. As you can see, its net margin is projected to be 32% in 2019 and 35% in 2020. This is considerably higher than the net margin of Horizon Limited, which we saw was around 5% in the previous example. So why is this? One of the reasons is this company is paying no taxes. Look at the tax line. They're paying zero taxes because of their special status of a trust. So as you can see, different businesses have different costs and profitability, and one of the advantages of financial ratios is that they allow us to compare and contrast across businesses. Next quiz question. Profit after tax of a company is 30 crores and its net sales are 100 crores. So what is the net margin of this company? And your options are 30%, 3%, 10%, or none of the above. Now let us take a look at the balance sheet of a solar power plant. Its major assets are fixed assets, that is plant and machinery used to generate and then sell electricity. Another major item is cash. You always want to make sure that any business has enough cash to meet its major expenses. The next major section of any balance sheet is equity. It consists of share capital, which is money received from angel investors like parents and friends, as well as institutional investors. This is the money that we can use to purchase plant and machinery and other assets. Retained earnings comprise the accumulated profits of a business. We can also invest these profits in buying plant and machinery as well as other assets. The next major section of any balance sheet is liabilities. It comprises of long-term loans taken by the bank to purchase plant and machinery. We have to repay both principal on these loans as well as interest. Another major liability is short-term loans, which are loans that have to be repaid within a time frame of 12 months, along with interest. The major rule, the golden rule of any balance sheet is that assets must equal liabilities plus equity. That is, your use of funds has to equal your source of funds. So naturally, the next quiz question is, what is the golden rule that governs any balance sheet? And your four options are below. I hope all of you will be able to answer this question correctly. Now let's take a look at the cash flow statement of a solar power plant. It comprises three major sections: cash flow from operations, cash flow from investing, and cash flow from financing. Cash flow from operations is driven by the profitability of the business, while cash flow from investing represents the major outflow in terms of purchase of fixed assets, in this case the plant and machinery, which is used to generate electricity. Cash flow from financing comprises two major sources: loans received from the bank, which have to be repaid along with interest, as well as money received from investors in the form of equity. Remember, equity does not have to be repaid. Net change in cash is simply cash flow from operations plus investing plus financing. Cash is one of the most important items. If you want to make sure you have enough cash to cover your major expenses, cash really is king. The next quiz question is, what are the main sources of financing for any company? And your choices are loans from the bank, equity, that is money from friends, family, and other sources, or both loans and equity, or none of the above. Now we reach one of the most exciting areas in finance, which is the whole area of financial forecasting and modeling. So where do we begin? We start with the sales forecast, in which we need to project quantity sold and price per unit sold. Quantity sold is determined by two factors. One is demand for a product in the market, as well as supply side constraints. In the case of a power plant, this is determined by the capacity of the power plant. Unit price, you want to make sure, is enough to cover your costs and earn you a reasonable margin. Asset requirements. Firm needs to invest in plant and machinery to be able to generate electricity. For a solar power plant, you need about 5.3 crores to be able to set up a 1 megawatt power plant. Financing. How do we raise the funds to buy these plant and machinery and other assets? Well, we can take loans from the bank, which we have to repay along with interest. And we can also take equity, that is, money from angel investors like friends and family, as well as other investors. Other assumptions that go into any forecast: interest rates, obviously, they govern how much your interest expenses on the loans you take. Inflation determines how some of your key costs go up, such as your labor costs and other administrative costs. Taxes payable to the government, that is determined by corporate tax rate as well as something known as minimum alternative tax, and we can go into these deeper in finance class for those who are interested. The next quiz question is, what are the major elements that go into any financial forecast? And your options are sales forecast, asset requirements, financing plan, or all of the above. Now let's take a look at one of the most important concepts in finance, which is time value of money. Let's take a simple example to understand how this works. Supposing you invest rupees 1000 from the salary that you get at the end of your first month on the job. Let's say you put in 1000 rupees in a savings account for 3 years, and this account pays you an interest rate of 10% per year. So how will your investment grow? 1000 rupees in the bank today. At the end of the year, you earn interest of 10% on 1000 rupees, which is 100 rupees. So your balance by the end of the year has grown from 1000 to 1100. Similarly, in the second year, now your opening balance is 1100 rupees. You earn another 10% interest on that. So you get more interest now, 110 rupees interest. So your closing balance increases further to 1210 by the end of the year. So each year, your balance grows and you earn interest on that outstanding balance. So cumulatively over time, you're earning interest at the rate of 10%, and that essentially represents your time value of money. Now let's take a look at a reverse example. Supposing you say you want 1000 rupees in the bank 3 years from now. So how much should I invest in the bank today? The simple answer to that is 751 rupees. You put in today, if it earns 10% interest each year, it'll grow to 1000 rupees 3 years from now. But how do I arrive at this number of 751? Well, the quick and easy formula from your finance textbook is as follows. Present value equals future value divided by 1 plus the interest rate to the power n. In this case, future value is 1000 rupees, interest rate is 10%, while n is the number of years that you're investing in the bank, which is 3 years. Your quiz question is, what is the measure of the time value of money? And your options are inflation rate, interest rate, exchange rate, or none of the above. This brings us to the concept of net present value, which is one of the most important tools used by finance professionals to make investment decisions. How do we decide to invest in a project? Well, we first determine how much is the initial investment needed to set up the project. Let's say it requires 1 million rupees. So that represents our outflow in year 0. We then forecast what are the cash inflows from the project over a certain time horizon. In this example, our time horizon is 5 years. We then take the present value of these future cash flows using the present value formula we just saw, and then we compare that to the initial investment. If the present value of future cash flows is greater than the initial investment, then we say that the net present value of the project is positive and we go ahead and invest in the project. Now let's take a look at some very important terms when it comes to understanding the whole concept of net present value or NPV. First is time horizon. Usually this is governed by the physical life of the plant. In the case of a solar power plant, this is 25 years. However, in many cases, firms opt for a shorter time horizon depending on how long into the future they want to plan. In this example, we've taken the planning horizon to be 8 years. Another important estimate that has to be made is how much initial investment is required to set up the project. i.e., how much do we need to invest in plant and machinery and other assets to get the project started. Operating cash inflows, these are determined by the profitability of our project, which in turn is governed by sales to a large extent. Terminal cash inflow, this is the cash inflow we receive on terminating or ending the project at the end of its useful life. Another important assumption is the discount rate. It's what we have been referring to as the interest rate up to now. How the discount rate is calculated is something that we will get into in finance class. In this example, we use a discount rate of 10%. So using all the assumptions that we just discussed and adding a few more into the mix, we get an NPV which is positive, and therefore the firm is likely to invest in the project. So your quiz question on NPV is, what are the major drivers of net present value or NPV of a new project? And your choices are after-tax operating cash inflows, initial investment, discount rate, or all of the above. Now let's take a closer look at our solar example once again. I worked for many years in the energy industry, and so energy and solar is something which is very close to my heart. So for a typical 1 megawatt solar plant, we typically have to spend 5.3 crores to set up the plant. In this case, we're looking at a really big solar plant of 100 megawatt, and so our initial investment has to be proportionately higher at 530 crores. We project cash inflows from the project over a 25-year time horizon, which corresponds to the useful life of the solar power plant. So we project from 2018 all the way up to 2043. Cash inflows are governed largely by the profitability of this project, which in turn is largely governed by revenues and costs. We put in some other assumptions into the mix, and our NPV works out to be 113 crores using a discount rate of 9%. Since NPV is positive, ideally we should go ahead and invest in this project. Next quiz question is, when does a firm typically decide to invest in a new project? And your options are NPV is positive, when NPV is 0, when NPV is negative, or none of the above. A much simpler technique to assess return on investment and decide whether to invest in a project is to use the formula for return on investment shown here, which is simply operating profit divided by initial investment. So if I tell you that the operating profit of my solar plant is 50 crores in the first year of operation, and we know that the initial investment required is 530 crores, then our return on investment is simply 50 divided by 530, or 10%. So we save on all the time spending on the detailed NPV calculations and get a quick estimate right here using this formula. The next quiz question is, if the operating profit of a manufacturing business is 15 crores and its initial investment was 150 crores, then what is its return on investment or ROI? And your options are 10%, 100%, 5%, or none of the above. Now let's take a look at different types of business transactions. Transactions can broadly be bucketed into two categories. One is acquisitions, where one company acquires one or more units of another company. The other is divestitures, when a company sells off one or more of its units to another company. Within acquisitions, one of the most common types is mergers. That is when two entities or units combine together into one. Demergers are essentially the opposite of that. It is when a company decides to sell one or more of its units to another company. Purchase of the unit, as the name suggests simply, is when a company decides to purchase a unit or division of another company. Partial sell-off is the mirror image of that, when a company decides to sell off one or more of its own units. Leverage buyouts are interesting because they involve a substantial amount of debt or loan financing to be able to purchase another unit or division. Sale of an equity stake. You would have heard of the recent case where the founders of Flipkart, Sachin and Vinny Bansal, have sold off a lot of their equity stake in their company to Walmart, who now has a controlling interest in the company. We'll analyze this in greater depth in class, but please just keep these concepts in mind. So our quiz question based on what we just discussed is, Flipkart's owners Sachin and Binny Bansal recently sold their shares in the company to Walmart. What kind of transaction is this? And your options are sale of equity stake, demerger, merger, or none of the above. Now, depending upon the size of a business, its ownership structure can vary, and this has implications for decision making as well as financial disclosure in line with government regulation. The largest companies are public listed companies which trade on the Bombay Stock Exchange. They have a large number of shareholders. Decision making is very rigid, often requiring shareholder approval for the biggest decisions. And a lot of financial disclosure has to be made in line with SEBI's Act as well as Companies Act. Smaller, private limited companies have fewer shareholders, decision making is more flexible, and financial disclosure norms are less stringent, so it makes compliance easier for such companies. Your quiz question is, large public companies have to disclose more financial information in line with government regulations compared to small private companies. Is this statement true or false? The organizational structure of any company has certain features. At the very top sit the shareholders, who are also the owners of the company. They in turn appoint a board of directors to oversee the management of the company. The board in turn delegates managerial responsibilities to the chief executive officer or CEO. The CEO has various heads of department reporting to him. These are the vice presidents or VPs of departments like legal, marketing, finance and accounts, operations, and HR. Within finance and accounts, you have the controller who leads the team responsible for building financial statements, while treasurer is more responsible for planning for cash needs. There's an internal audit committee which reviews the financial statements of the company. There are also external auditors. The big four auditors are PwC, Deloitte, KPMG, and EY. So if any of you guys want to work for them, then you'll have to be pretty good with accounting and finance. Your associated quiz question is, who sits at the very top of the organizational structure of a company? Your options are shareholders, board of directors, CEO, or none of the above. This brings us to the end of the section on financial management and accounting. We now begin the section on cost management. You can refer to chapters 2, 11, 12, and 13 of your cost management textbook also for more details. Before we dive into the details of cost management, let's just try to understand why it's vital to estimate costs accurately and assign them to relevant cost objects. Cost objects can be anything from products, customers, department, or activities, and assigning costs in this manner helps us to understand why certain costs are going up while others may be going down. It also helps us hold relevant people accountable for these costs. In the long run, assigning costs accurately also helps us make better decisions. This brings us to the first quiz question of this section, and it is, what are examples of cost objects? And your options are project, customers, activities, or all of the above. Let's take a look at how cost assignment is done. There are three methods. One is called direct tracing, which is based on physical observation of costs and is the most accurate but least practical. Certain costs which cannot be traced to cost objects are assigned using a method called allocation, which is least accurate and thus should be avoided in most circumstances. Let's take a look at driver tracing. In this method, a proxy or driver is used to estimate certain costs. Supposing we want to estimate cost of electricity consumed in running a sewing machine. We can use a simple formula, cost of electricity per hour into number of hours that the machine is run. Now supposing we know that the cost of electricity per hour is 10 cents or $0.1. We also know that our machine is run for 200,000 hours. So here the cost of electricity is simply 0.1 into 200,000, which is $20,000. And machine hours is the proxy or driver that we use to estimate costs. So the next quiz question is, what is the preferred method of cost assignment? Is it direct tracing or driver tracing or allocation or none of the above? Let's take a look at the innovative cost assignment technique of activity-based costing. In traditional cost control, costs were assigned to organizational units and unit managers were held accountable for the same. In activity-based costing, on the other hand, costs are assigned to specific activities. This is followed up by what is known as a driver analysis to understand what are the factors that drive an activity's costs. That is why were costs incurred. We then get into what work was done, i.e. what activities were performed. And finally, we evaluate how well activities were performed through a detailed performance analysis. So the next question is, what are the benefits of activity-based costing? And your options are driver analysis, into what factors drive an activity's cost, or analysis into why costs were incurred, or evaluation of how well activities were performed, or all of the above. Let's take a closer look at an example of a manufacturing company. Now, any manufacturer has certain direct production costs, which include cost of raw materials, labor, and overhead, as well as some non-production or indirect costs known as selling, general, and administrative expenses. If we look at this example of a cell phone manufacturer, we notice that its total production cost is $720,000 for producing 30,000 cell phones. So what is the cost of producing one cell phone? It is $720,000 divided by 30,000 or $24 for producing one cell phone. So we say its total production cost per unit is $24 per unit. Now, if we take a look at the raw material cost or direct material cost specifically, it's $150,000 for producing all the 30,000 cell phones. So what is the direct material cost per unit? It is $150,000 divided by 30,000 or $5 per unit. Similarly, we can find the unit cost of labor as well as variable overhead and fixed overhead. And if we do that, we find direct labor is $3 a unit, variable overhead is $1 a unit, and fixed overhead is $15 a unit. And if we add all that up together, the total production cost is $24 a unit. So we know that the biggest driver of cost here is the fixed overhead, $15 per unit. So the advantage of looking at costs on a per unit basis is to understand what's driving costs up and down. So the next quiz question is a calculation question. It is, a textile manufacturer produced 100,000 units of textiles. Total cost incurred was USD 3 million. What is the cost per unit? And your options are $30 per unit, $0.33 per unit, or $10 per unit, or none of the above. So what is the cost of goods manufactured? To understand this, we need to understand the flow of a manufacturing organization. First, we start with raw materials. In the textile manufacturing industry, for instance, this can be materials like yarn and thread, as well as other materials that constitute our raw material costs. We then add labor on top. This is the people who are involved in manufacturing the textiles in the factory. Any other direct costs, known as overhead costs, are added on top of this. And these three items together, raw material, labor, and overheads, constitute our total cost of goods manufactured. Once the good, in this case textiles, are manufactured, they are stored in what is known as finished goods inventory and are ready for sale to the customer. Next quiz question is, what is the flow of goods in a manufacturing setup? And your options are 1. Raw material to work in process to finished goods, or 2. Work in process to raw material to finished goods, or 3. Finished goods to work in process to raw material, or 4. None of the above. Once a good is sold, it moves out of finished goods inventory and its associated cost is booked on the profit and loss account of the manufacturing company. This is known as cost of goods sold, and it consists of all direct production costs, including raw material, direct labor, and overhead consumed in manufacturing the units sold. Time for the next quiz question. As we discussed, cost of goods sold comprises of certain direct costs incurred in selling a good. So you need to tell me which of the following costs are included as part of cost of goods sold, and your options are cost of raw material only, cost of raw material and labor, cost of raw material, labor and overhead expenses, or none of the above. Just-in-time manufacturing is an innovative and unique manufacturing technique that enables a manufacturer to minimize production costs and inventory levels through greater efficiency and processes by ensuring that raw materials arrive just in time. This brings us to the next quiz question, which is, what are the benefits of just-in-time manufacturing? Please select the best answer. And your options are minimize production costs, minimize inventory levels, greater process efficiency, or all of the above. Let's shift gear a little bit and focus on strategic cost management. Competitive advantage is all about maximizing customer value. How do we define customer value? Customer value is simply customer realization minus customer sacrifice. Customer realization is the benefits we deliver to the customer in terms of unique product features, brand name, as well as other support services. Customer sacrifice represents the cost to the customer of purchasing the product. This is the price they pay for the product when they go out into the market. Cost leadership strategy focuses on minimizing customer cost and thus maximizing customer value. Differentiation strategies, on the other hand, focus on maximizing perceived benefits to the customer and thus maximizing customer value. Nabisco, a manufacturer of biscuits, chose to manufacture animal-shaped biscuits which appeal to children who were one of its major customer segments, thus maximizing value for those children. Strategic positioning is all about choosing the optimal mix of cost leadership and differentiation while focusing on certain customer segments. The next question is, what are the different elements that strategic positioning comprises of? And your options are cost leadership only, cost leadership and differentiation, or cost leadership, differentiation and focusing, or none of the above. An important framework for making strategic decisions is the value chain framework. It helps a company understand where it is situated in the value chain in relation to its competitors, suppliers, and customers. For instance, Firm A has presence across the petroleum industry in segments like oil exploration, distribution, as well as gas distribution and service station. On the other hand, Firm B and C have limited presence, Firm B in oil exploration and distribution, and Firm C in distribution and refining. Knowing costs and revenues of different stages within the value chain is vital for making important decisions that help a company improve its performance. This analysis can also help a company understand whether it needs to, for instance, sell off a part of its business that is not doing well and is not profitable, thus narrowing its participation in the value chain. The associated quiz question is, what are the advantages of value chain analysis? And your options are 1. Awareness of position of a firm with respect to customers, suppliers, and competitors. 2. Knowledge of revenue and profits at different stages of the value chain. 3. Better decision making. Or 4. All of the above. Let's take a look at the concept of product lifecycle cost management. There are 4 different perspectives: marketing, production, consumables, and the interactive point of view that brings all of these perspectives together. Naturally, from a sales and marketing point of view, the objective is to maximize sales. On the other hand, guys in charge of production want to minimize cost. As far as customers are concerned, they want to maximize product performance at a given price. Price, in turn, is determined by your cost of production. The interactive point of view basically reconciles these different point of views and says the objective really is to maximize profit by maximizing sales and minimizing costs. Next quiz question is, the interactive viewpoint on product lifecycle management comprises of which of the following perspectives? And your options are marketing viewpoint only, production viewpoint only, marketing, production, and consumable viewpoints, or marketing and production viewpoint. This brings us to one of the most important strategic frameworks, which is the balanced scorecard framework. It translates strategy into 4 perspectives: financial, customer, process, and infrastructure, and specifies goals for each of these. The financial perspective emphasizes revenue growth and cost reduction. Customer perspective focuses on maximizing customer value. Process perspective emphasizes process quality, efficiency, and innovation, while infrastructure perspective focuses on improving employee capabilities and motivation. Okay, next quiz question. Balanced scorecard framework translates strategy into which of the following perspectives? Your options are financial only, financial, customer, process, and infrastructure perspectives, or financial, customer, and process perspectives, or financial and customer perspectives. This brings us to the end of the section on cost management. Next up is business statistics. You can refer to pages 10 to 12 and 211 to 214 of your complete business statistics textbook for more information. One of the most important applications of business statistics is to analyze data to understand trends, patterns, and behaviors. A survey was recently conducted in the state of Maharashtra in India to understand whether customers would be willing to pay more for fewer power cuts and access to higher quality electricity. The results are displayed on the slide in front of you. The vertical axis in this chart represents frequency, or the number of people who gave a certain response, while the horizontal axis represents the amount they're ready to pay more for each unit of electricity. So the most frequent response that was given was rupees 2 per unit. 4 people in our survey sample set said that they would pay up to rupees 2 per unit extra for fewer power cuts. This value represents the mode. In contrast, the median represents the middle value of this distribution and works out to be 2.2. Last but not least, mean is the average value. It's the sum of all observations over number of observations and works out to be 2.3. Therefore, on average, people were ready to pay up to rupees 2.3 per unit of electricity more to ensure fewer power cuts and higher quality electricity. So the first quiz question in business statistics is, what is the mode of a sample set? Please select the right answer. Your options are the value in the middle of the sample set, or the most frequent value in the sample set, or the average value of the sample set, or none of the above. To ensure that the results of any survey are meaningful and insights and conclusions can be drawn about the larger population, it is important to use the random sampling approach. In this approach, we obtain samples by interviewing people at random locations, random times, and random dates to ensure that the data we get is reflective of the broader population. Stratified sampling is another approach in which the population is stratified into two or more subpopulations called strata. From each strata, a random sample is then selected. Alright, next quiz question. What is the goal of random sampling? Please select the best answer. And your options are 1. The goal is to obtain samples that are reflective of the larger population. 2. Draw meaningful insights and conclusions and trends. 3. Both of the above. Or 4. None of the above. This brings us to the next section on international business. You can refer to chapters 11 and 12 of your international business textbook for more details. How do we choose a location for international business? Here are some of the factors to be considered. The first falls under the bucket of operating environment of the business. Within this come physical and social factors, including political policies, regulations, as well as economic factors. Competitive factors also come in. To give you an example, the IT and BPO industry really took off in India because of the low cost of labor, giving India a competitive edge over other markets. The other bucket is operations. Here we consider factors like the company's objectives as well as business strategy in order to be able to select an appropriate location for international business. So the next quiz question is, what is the main reason why many companies choose to outsource their IT operations to India? And your options are favorable political policies, or low cost of labor, or favorable laws and regulations, or none of the above. A very useful tool for assessing what is the right location for setting up international operations of a business is what is known as the Opportunity Risk Matrix. In this matrix, we rate each country on a scale of 1 to 10 along different dimensions of risk and opportunity, and then we map each country onto this matrix. The goal really is to maximize opportunity and minimize risk when deciding which country to operate in. The most desirable quadrant for us to be in is the top right quadrant, which minimizes risk and maximizes opportunity. Time for the next quiz question. As discussed, the opportunity risk matrix helps companies in deciding which country to operate in. Firms choose the option which 1. Maximizes opportunity only, 2. Minimizes risk only, 3. Maximizes opportunity and minimizes risk, or 4. None of the above. This brings us to the section on Management Information Systems. You can refer to Chapter 9 of the textbook on this subject for more information. An example of management information systems is e-commerce systems. Many of you may have used Amazon and Flipkart for online shopping and may be familiar with their website, which has many innovative search features, a detailed product catalog, as well as promotions and discounts on certain select items. Personalized recommendations and targeted ads to suit your particular tastes and interests can also at times be seen. Customer service can be fairly prompt, with Amazon and Flipkart issuing refunds in case you choose to return certain items. The status of these can be monitored online. We will be discussing Amazon, Flipkart, and other e-commerce startups in greater depth in class. Sample quiz question is, what is an example of a management information system? The options are your neighborhood pawn shop, or e-commerce system, or all of the above, or none of the above. Now let's get on to the final section on marketing. Let's take a quick look at the 4 P's of marketing in the context of Reliance Jio mobile phones, which many of you may be using. The first P, product. Well, in this case, we're really looking at a service that is high-speed data and voice services on our mobile phones. Price. Well, that was the major reason many people switched from their existing mobile plans to Reliance Jio, because Jio was offering extremely competitive prices. In fact, data rates were one-third of existing data rates at the time of launch. Place. Reliance used a combination of physical retail spaces as well as e-commerce sites like AGO. Promotions. A variety of Bollywood personalities were roped in for promotional activities, including superstar Shah Rukh Khan, who was their brand ambassador. The next quiz question is about applying the 4 P's framework to an e-commerce business like Amazon. You can select the most suitable option from the ones listed below. Let's take a look at the topic of break-even analysis. In order to understand this further, we first need to understand what are the fixed and variable costs of any business. So let's take a look at the profit and loss account of a company one more time and try to classify each cost item as either fixed or variable. Variable costs are those that increase with production, while fixed costs have to be paid whether we're producing anything or not. So the first cost item on any P&L is the cost of goods sold, which comprises raw material, labor, and overhead costs directly incurred in the production process and is therefore variable in nature. Selling, general, and administrative expenses, or SG&A expense, has both a fixed and variable component. The fixed component comprises salary of administrative employees, which has to be paid regardless of whether we're producing anything or not, and is therefore a fixed expense. The variable component increases with production. Depreciation of fixed assets, including plant and machinery and other equipment, is incurred regardless of whether we're producing anything or not, and is fixed in nature. Similarly, interest on the loans we take from the bank has to be paid whether we're producing anything or not, and is therefore a fixed expense. So if production were zero, our variable costs would be zero too, but our fixed costs still have to be paid. Let's take a closer look at the example of a textile manufacturer to understand how much this manufacturer has to produce in its first year of operation in order to break even, i.e., how much does this manufacturer have to produce in year one in order to recover its costs and incur zero profit, zero loss. Supposing this is a manufacturer of saris, and the cost of goods sold of one sari is rupees 3,000, while the variable SG&A expense on this one unit is rupees 625. Therefore, the total variable cost of one unit is rupees 3625. Let's now take a look at the fixed cost. Fixed SG&A expense of rupees 20 lakhs in year one, depreciation of rupees 5 lakhs in plant and machinery and other fixed assets, and interest on loans of rupees 7 lakhs. So the total fixed cost in year one is the sum of the above three line items and works out to be 32 lakhs. So the manufacturer has to somehow recover this fixed cost of 32 lakhs by selling a certain minimum quantity of saris. Let's call this minimum quantity Q. If the selling price of one sari in the market is rupees 5,000 and its total variable cost per unit is rupees 3625 as discussed earlier, then the contribution margin is simply the selling price of one sari minus its variable cost, which is 5,000 minus 3625 or rupees 1375 per unit. So that's the contribution margin on one sari. The contribution margin on all saris is simply the contribution margin on one sari into the number of saris Q. So this total contribution margin has to equal 32 lakhs in order to recover a fixed cost. So if we solve the equation shown in the slide in front of you, then the minimum quantity Q works out to be 2327. Therefore, we have to sell a minimum quantity of 2,327 saris in year 1 in order to recover fixed costs and break even. To summarize break-even analysis, the contribution margin per unit is simply selling price per unit minus variable cost per unit. At the break-even point, total contribution margin is just enough to recover fixed costs. In other words, at break-even point, we are selling just enough quantity to recover our costs, and therefore at the break-even point, overall profitability is 0 and profit after tax is 0 too. Two sample quiz questions. One, what is the contribution margin per unit? And your four options are below. The second question is, at the break-even point, total contribution margin is just enough to recover total fixed costs. Is this statement true or false? Let's take a closer look at the concept of differentiation. How much would you be willing to pay for a product? What determines the price of a product? Is price simply determined by the cost of production? Or are customers ready to pay a little bit more for higher quality products with certain unique features and other perceived benefits? Let's take the example of Lifebuoy soap, which many of you may have used. The Lifebuoy brand has both low priced and higher priced premium products. So while Lifebuoy Total, the standard soap, is priced at Rs 25, Lifebuoy Clinic Care, which promises customers extra germ protection, is priced at twice that at Rs 50. So customers essentially are ready to pay a premium for the perceived benefit of extra germ protection. This is an example of differentiation, which is essentially a mechanism of increasing customer value through unique product features and benefits which help in differentiating a product over other similar products. So the final quiz question is, what determines the price of a product? Is it cost of production only, or is it quality of product only, or is it cost, quality, unique features, and perceived benefits to the customer, or is it none of the above? This brings us to the end of the lecture. I do hope you guys are still awake. Thank you for listening.